All right, let's talk stocks. You've probably heard people say, I'm investing in the stock market, or I bought some shares. But what does that actually mean? How do stocks work? Why do people buy them? And more importantly, should you? Let's break it down. No jargon, no fluff. So at the most basic level, a stock is a piece of ownership in a company. When you buy a stock, you're literally buying a tiny slice of that company. That piece is called a share. Let's say a company like Apple is worth $1 trillion, and it's divided into 10 billion shares. If you buy one share, you own 1/10 billionth of Apple. It's not much, but technically, you're now a part owner of one of the biggest companies in the world. Pretty cool, right? Now, why would a company sell shares of itself? Well, companies need money to grow, build, hire, research, expand. So instead of taking out a loan, they can go public and sell shares to the public on the stock market. This way, they raise money, and in return, investors get a piece of the company. Now here's where it gets interesting. The price of a stock goes up and down based on a bunch of things: supply and demand, news, earnings, hype, fear, trends, interest rates, basically what people think the company is worth in the future. If more people want to buy the stock, the price goes up. If more people want to sell, the price goes down. That's the market in action. So how do people make money with stocks? Two main ways. Capital gains. You buy low, sell high. Let's say you buy a stock for $50 and a year later it's worth $70. You sell it, boom, you made $20 profit per share. Simple. Dividends. Some companies share part of their profits with shareholders. That's called a dividend. It's like a bonus just for holding their stock. Not all companies do this, but many do, especially bigger, more stable ones. And of course, people also lose money on stocks. Buy high, sell low. That hurts. And yes, it happens. A lot. So how risky is it? Well, stocks are considered more risky than putting money in a savings account, but they also offer the potential for much higher returns. Over the long term, the stock market has historically gone up. But in the short term, it can go all over the place. Volatility is part of the deal. Now let's talk about the different kinds of stocks. You've got blue chip stocks, big stable companies like Microsoft, Coca-Cola, Johnson & Johnson, not flashy, but usually solid. Growth stocks, companies that are expanding fast, like Tesla or Amazon in their early years. High potential, high risk. Dividend stocks, companies that pay consistent dividends. Great for income-focused investors. Penny stocks, super cheap stocks, often under $5. High risk and often scams. Be careful. There's also the difference between individual stocks and ETFs. An ETF, or exchange-traded fund, is like a basket of stocks. Instead of buying one company, you buy a bunch in one package. It spreads the risk. Think of it like a fruit salad instead of one single apple. Still with me? If this is helping you understand stocks better, give the video a like. It really helps the channel out. And if you want more videos like this, simple, clear, and to the point, hit that subscribe button. Let's keep going. Now, where do you actually buy stocks? Most people use online brokers or investing apps, platforms like Robinhood, eToro, Fidelity, or in Europe, things like DeGiro or Trade Republic. You make an account, deposit money, and you can start buying shares. But before you just jump in, here are some quick tips. Do your research. Don't just buy a stock because a friend told you or TikTok said so. Think long term. Trying to get rich quick usually doesn't end well. Diversify. Don't put all your money into one company. Spread it around. Don't invest money you can't afford to lose. Seriously. It's not gambling, but it's not a guarantee either. You might hear terms like bull market and bear market. A bull market means stocks are going up. A bear market means they're going down. Just think. Bulls go up with their horns, bears swipe down with their claws. Easy. Also, don't panic if your stocks go down a bit. That's normal. Prices go up and down daily. What matters is the bigger picture. If the company is strong and your investment is solid, trust the process. Now, let us clear up a common myth. You don't need to be rich to invest in stocks. These days, you can invest with as little as $1 or euro. Many apps let you buy fractional shares, meaning you can own part of a stock even if you can't afford the full price. And no, you don't need to be a finance genius either. Anyone can learn this. If you can understand how to shop online or use a phone app, you can invest in stocks. It's just about getting started, learning bit by bit, and being patient. So, to sum it up, stocks are tiny pieces of companies. You can make money through price increases and dividends. The market moves based on emotion, news, and expectations. Long-term investing tends to pay off more than quick flips. Diversification and patience are key. And no, it's not just for rich people. Investing in stocks can be a powerful tool for building wealth over time. It is not a guaranteed win, and there are risks. But if you take the time to learn, it can seriously change your financial future. Thanks for watching. If this video helped you understand stocks in a clearer way, hit that like button. And if you want more plain English guides like this, subscribe to the channel. See you next time.